We've all been to a bank, right? You go in, open an account, give them your money, and you walk out thinking everything is okay, and your money is sitting safely with your name on it. Well, that's not exactly true, is it? That money is now theirs, and that's the law. You probably didn't know that, and a few other things I'm going to talk about today. Welcome back to the channel. Today I'm going to give you 7 facts about your bank that you should know, but probably don't. Doesn't matter how old you are, what you do, or where you live. It applies to you and your bank as well. Do whatever you want with that information. But it's common sense. You should have some. 1. That money isn't yours. Once you deposit the money, it stops being yours. By law. You didn't store anything. You made a loan to the bank. You're just their creditor. That number on your screen is an IOU from them. Most people walk into a bank thinking they're a customer getting a service. You're a lender, and what you get back is a promise and a monthly fee. And as history shows very often, even if they owe you that money, they can delay it. They decide when, not you. 2. Your savings account is the safest way to lose money. Here's the part nobody wants to do the math on. Take $100,000. You put it in a savings account in 2020 and left it there. Safe. Responsible. Exactly what you were told to do. Today your statement says $101,500. You earned $1,500 in 6 years. Meanwhile, prices went up roughly by 30%. So to have what you started with, you'd need $130,000. You've got $101,000. That $100,000 now buys what $80,000 bought in 2020. You lost $19,000 sitting still, doing nothing wrong. And 30% is the official number. Look at what you actually buy. Ground beef, up 80%. Electricity, up 50%. Eating out, up 50%. Gas, up 47%. Rent, up 44%. That's government data, not a theory. Your bank paid you 0.38%. The big ones paid 0.01%. Amazing gains, right? 3. Fractional reserve banking. In simple words, how much money is actually inside the bank at any given time? We all think the bank is the place where the cash is being kept, right? Absolutely not. Legally, the bank is allowed to keep 0% of it in cash. Even if you think they hold millions or billions, they don't. In the US, it's 0. In Europe, it's 1%. It used to be 10. Now, it's nothing. Which leads to a very simple fact. If you want to withdraw a larger amount, they just don't have it. That's why they tell you to request it 3 to 5 business days in advance. Which is a joke, simply because emergencies can't wait that long. 4. How do banks make money? Simple. Mostly from lending it out. Your money goes out as mortgages, as credit, as loans to other people at rates far higher than anything they pay you. That gap is the business. Then there's everything else. Fees on your account. A cut of every card transaction you make. Currency exchange, overdrafts, and the rest they invest. Long term, in things that are supposed to be safe. And that's where it gets interesting, because they play very loose with the word safe. Silicon Valley Bank, 2023. They bought government bonds, the safest thing you can buy. Then rates went up, those bonds lost value, and when customers came asking for their money, it wasn't there. Gone in 2 days. Nobody committed fraud. They just took your money, tied it up somewhere, and couldn't get it back fast enough. These are the people you trust with everything you've earned. The professionals. The safest place for your money. And yes, I'm being sarcastic. If you're learning something new today, like the video and subscribe for more useful content. It helps the channel grow. 5. They can hold your money for as long as they want. They can freeze your account, run compliance reviews, change your daily limits, demand advance notice for anything large, and every single one of those is justified with a respectable reason. Fraud, crime, regulation. whatever. But the fact is, they can stall for as long as they need, while they scramble to find the money. Because they don't have it, as we already established. And they can do all of it because of point one. They own the money, they make the rules, you signed the contract but didn't read the fine print. That's on you. 6. Fees on the fees over other fees. Not only do they take your money and do whatever they want with it, not only do they hand you a guaranteed way to lose purchasing power, but to add insult to injury, they stack every fee in the world. And half of them you don't even know about. 99 cents here, another few dollars there. It shows up on your statement and you don't bother to check. In some cases, the total of maintenance, withdrawals, normal usage, card fees, whatever else they come up with, can amount to over $500 a year out of your pocket for the privilege of them holding your money. And take 99 cents from 10 million people, and that's $9.9 million. And that's just one charge for 1 month, which they need to cover the next point. 7. They get caught and nothing happens. Every now and then, it's in the headlines. One of the big banks got caught. Citigroup, JP Morgan, Barclays, RBS, UBS. They all pled guilty to criminal charges for rigging markets. Guilty. Around $5.8 billion in penalties. Nobody senior went to prison. Every single one of them still operates. HSBC laundered cartel money. Admitted to it. $1.9 billion in fines. Still open. Operating just fine. So all those fines and penalties they pay, where do you think that money comes from? Definitely not from their pockets. They work with your hard-earned money, not theirs. Think about it. So what can you do about all this? You've got a few options. Don't put the cash under the mattress. But here's what actually works. Start with your own statements. Add up 1 month of fees, then a year. That's your first step. Then move to the savings rate. Are you sure you're on the best conditions available? Have you actually searched for alternatives? A place where your money can sit and earn more than what your bank offers? I'm sure there is one. You just haven't done the research, have you? And that alone is a guaranteed way to stop losing money in the dumbest way possible, leaving it in a bank savings account. Fintech companies are constantly developing, competing, offering much better conditions than the established names. Have you looked at any of them? Just check whether your money is actually insured there, because some of them aren't banks, and that protection works differently. Split your money across more than one institution. That's smart. And find out your same-day cash limit before the day you need it. All of this takes 1 afternoon, maybe 2. And it beats most of what you'll do with your money this year because you're not chasing a return. You're closing a leak. Sometimes it's not about making money, but about protecting what you've got. Comment below about the last fee you got charged that you didn't know existed. What was it for? And what did it cost you? And the video popping up on your screen is definitely a good one for you to watch right now. See you in the next one.